Let me ask you a slightly uncomfortable question. What if I told you you might be paying thousands, maybe tens of thousands more in taxes than you need to? Not because you did anything wrong, but because nobody ever showed you a better way. Today, I'm walking through 4 smart tax moves most retirees completely miss. And if you get even one of these right, you could keep a whole lot more of what you worked so hard to build. Quick disclaimer, this is not about dodging taxes, this is about wisdom. Pay what you owe, but don't tip the IRS. Jesus once was asked whether or not the people of his day were required to pay taxes, and he said, "Render unto Caesar that which is Caesar's." But he did not say render extra because you don't know your options. Let's dive in. Smart tax move most retirees miss, number 1. If you have company stock inside your 401k, please listen closely. There's an important concept called net unrealized appreciation. This allows you to split your taxes on company stock in your 401k into 2 parts. What you paid for the stock is taxed as ordinary income. For most of us, that's 22 to 24%. The growth in value, though, would be taxed at capital gains rates, which for many is only 15%. And so that's a significant tax savings. Here's an example. You invest $100,000 inside your 401k in your company stock, but now it's worth $500,000 due to market gain. Without net unrealized appreciation, all $500,000 would be taxed as income. You could roll that out to an IRA, but eventually it's going to be taxed as income. For most of us, that's between 22 and 24% federal, plus any state income tax depending on where we live, as I mentioned before. With net unrealized appreciation, however, in this example, only $100,000 would be taxed at income tax rates, and $400,000 would be taxed as capital gain, or if it's been held over a year, long-term capital gain rates, typically 15%. That's a tax savings in this example of $40,000. But wait, as often as we talk about taxes, there are some caveats. There are some rules that you have to be aware of. Break the rules and this opportunity goes away. Number 1, this must be employer stock. It can't be mutual funds or any other investment inside your 401k. Number 2, you must have a triggering event like age 59 and a half, retirement, or you've left the company. Number 3, you must distribute all assets from your 401k in that same tax year. Number 4, don't roll your company stock into an IRA. This blows up the whole thing. It's not going to work. And most importantly, number 5, do talk with a CPA or a financial advisor who understands taxes. This is a very complicated strategy, and you have to make sure you follow all the rules. Be sure you're getting guidance from a qualified professional who knows you and your tax situation. Smart tax move most retirees miss, number 2, strategic yearly Roth conversions. This one sounds crazy at first. Pay taxes now on purpose? Why? But hear me out. You strategically move just enough money each year from traditional IRA to Roth, or from 401k to Roth, so that you pay taxes at today's rate because your tax rate later on is projected to be higher than it is today. How does this work? Later in retirement, required minimum distributions kick in, and those stack on top of Social Security benefits. Your tax bracket starts to creep up. Suddenly you find yourself paying more in tax than you originally were when you retired, and it's too late then to do anything about it. Again, how this works specifically is each year you want to convert just enough from your pre-tax accounts, IRAs, 401ks, to Roth to fill up that tax bracket, or we say fill up that tax bucket. That way you are taking advantage of that lower tax bracket than the one that you're projected to be in later on in life. Here's an example. If you're 62 and you're retired today, your taxable income might be very low. With the help of a financial planner or CPA, you can calculate where your income will likely be at age 75 when your required minimum distributions are kicking in. Then you calculate how much of your pre-tax retirement funds you can convert to Roth at a lower tax rate than the rate you'll be paying at age 75. I think of this kind of like shopping at the tax store when they're having a sale, instead of paying full price later on. Except, let's face it, it's not really a store and you don't get to take home any sweet deals to show your family, so it's not that much fun. Let's talk about smart tax move most retirees miss, number 3, tax loss harvesting, and I would say systematic tax loss harvesting. Doesn't that just make you feel all warm and fuzzy inside? I mean, systematic tax loss harvesting, those middle 2 words are anathema in the financial world. No one likes taxes or losses, and the other 2 words sound like an episode from The Walking Dead. Systematic harvesting. But this strategy, when practiced regularly and correctly, can be a real game changer from a tax perspective. Why? Because it turns something bad into something highly useful down the road. Let me explain. The IRS says if an investment in a regular taxable account drops below what you paid for it, you can sell it, realize the loss, and then bank that loss to offset future taxable gains. You've probably heard all that before. But here's the magic part most people miss. If you don't use all the losses you take this year, you can offset up to $3,000 against income and then carry any additional losses forward year after year until you have a gain to offset those losses. It's like building this bank of tax losses that you can use whenever you need them. Selling a business one day, you might have a huge capital gain, and these losses can help you. What about selling a piece of property? Same thing. Your bank of losses can be there for you to use at that time. When I talk about harvesting tax losses, some people say, why should we be looking for losses? Don't we just want gains? Well, the reality is, in any given tax year, if you're properly diversified, over half of your investments will likely go down in value, even though your total account value may have gone up. Markets are volatile. You have investments working in different directions. By systematically looking for and taking tax losses, you can take advantage of volatility from a tax perspective. And as long as you stay invested and diversified, you can enjoy similar returns as you would have had anyway. If you can enjoy similar returns while banking losses to help you lower that tax bill, why not? In case you're wondering, the IRS is totally fine with this, but there is one important rule that we don't want to miss. Don't repurchase the same investment back within 30 days. That's called a wash sale, and the IRS says, nice try, but no. Instead, quickly buy back a substantially different investment that has also dropped in value. For example, let's say you owned Coca-Cola and it went down in value and you sold it, turn around and purchase Pepsi or some other similar investment that is different but has also gone down in value. Is this too complicated? There are investment managers who will do all of this for you for a relatively small fee, and the results can be pretty powerful come tax time. And finally, smart tax move most retirees miss, number 4, qualified charitable distributions. If you're 70 and a half or older, this one is really incredible from a tax perspective. Did you know you can give directly from your IRA to a 501c3 charity and the distribution will not count as income on your tax return? If you're giving already, or if you want to give and you're over age 70 and a half with an IRA, or maybe you have another pre-tax retirement account that you can roll over into an IRA, you should almost certainly be taking advantage of qualified charitable distributions. How is this helpful? These distributions count towards your RMD, your required minimum distribution if you're at that age. They aren't taxed as income, and there's no need to itemize. You can still take your standard deduction. All this means less income tax, potentially lower Medicare premiums, and often less Social Security taxation, all while supporting something you care about. That's just tax smart stewardship at its best. How is this way of giving different than giving from a checking account or some other more traditional manner? When you give from your checking account, you get a tax receipt from the charity at the end of the year. Then you must add up all of your charitable gifts plus your state and local income tax, your mortgage interest, medical and dental expenses, other itemizable deductions. But if your total itemized deductions do not exceed your standard deduction, which is very often the case, you can't get any credit for them. You lose the ability to deduct them from your income, and that's where qualified charitable distributions are so powerful. If you give to a 501c3 charity directly from your IRA, you're moving cash that when withdrawn would have been taxed as income, but now it won't be taxed at all. The cash is distributed to the charity completely tax-free. For many retirees, giving from an IRA results in thousands of dollars in tax savings that they simply would not have been able to enjoy if they were giving from a checking account or some, again, more traditional manner. Let's wrap all this up. What are the 4 smart tax moves most retirees miss again? 1, net unrealized appreciation, better tax treatment on that company's stock. Number 2, strategic yearly Roth conversions, control when you pay those taxes and how much. Number 3, systematic tax loss harvesting, bank losses for future gains. And number 4, qualified charitable distributions, give in a tax efficient way. All 4 of these strategies can be huge for retirees who are trying to make the most of the resources God has given them them in retirement. We spend our lives trying to save and grow money for the years when we can't work, or maybe we want to be doing other things. But in retirement, the real game is not how much you make, it's how much you keep that matters. Let's not give any more to the government than we have to. These strategies aren't about beating the system, they're about being good stewards, being faithful with what God has given us. If this was helpful, please hit like, subscribe, share this with someone else who doesn't like taxes. And if you'd like to read more, I've included a list of online sources for this material in the description below. As always, if you'd like to talk with me through any of these ideas and see how we can help you in your tax situation, click on the link below to set up a no cost or obligation call. Always happy to help. I'm Matt Hearn. This is Method to My Money. Thanks so much for watching.